Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings Monthly Conference Call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press star 0. I would now like to turn the meeting over to Ms. Andrea Rubakovic. Please go ahead, Ms. Rubakovic.
Thank you. Good morning, everyone. Thank you for joining us so bright and early for a regular monthly advisory conference call. We're very sorry for the change of date and time of the call, but we do appreciate you being able to log in during a very busy time of year. As I was introduced, my name is Andrea Rubakovic, and I work here with Sarah and Nick as part of the advisory sales team. If I have not personally spoken to you already, I very much look forward to doing so in the near future. Going back to the call, David Burrows will today be providing a review of market leadership themes and portfolio positioning we have seen throughout the very tumultuous 2015. He will also share an outlook on the positioning of our portfolios heading into the new year. With this, I will hand it over to Dave.
Hey folks, happy holidays to everybody. I thought this might be a great opportunity to do a quick review on the year and then talk a little bit about current positioning and where we think markets are. So it's been an interesting year, lots of divergences, some winners and some losers. But just to sort of revisit, coming into this year, we came in with a view that we, number one, are in a long-term bull market for developed market equities. We also came into the year with a view that we are in a secular bear market for commodities, post the China boom that ended in 2012. We came into the year with a view that the U.S. dollar was likely to be strong and that emerging markets were likely to be weak. Emerging market currencies and economies and equity markets. We came into the year with a view that in equities, that there was some leadership in consumer, technology, healthcare, and financials, and that it was going to be a market where being targeted would make a difference, that there were some sectors that were likely to be challenged, like resources and basic materials, industrials, and utilities, given the fact that we are in a slowly improving economy. So there have been lots of gyrations through the course of the year. It hasn't been a great overall year for stocks, but if you were positioned in the right spots, it was okay. So just a quick review. Let's just start with income, because that's a topic that everybody wants to talk about. This income strategy that we've been running now for 15 years has really been a workhorse for us and for our clients. It's been a strategy that has generated very consistent returns with very low volatility. It's been a very open mandate that's let us skate through a lot of tough environments. This year was particularly difficult. To put a backdrop against it, the Canadian Dividend Growers Index, as of the close yesterday, was down 14.5%. If you looked at the high yield bond index in the U.S., down about 12%. Look at the U.S. Dividend Growers Index, down, I think, 3 to 4%. That's in Canadian dollar terms. If you were to look at it in U.S. dollar terms, obviously a lot worse than that. Income investing has been a difficult space to be in this year. The pipelines have been a disaster. Preferreds have been a disaster. Now, we have a very open mandate that allows us to do lots of different things. Where we spent the majority of the year was focused in things like consumer and financials, technology less so because of the yield constraint. So those things are positive. The thing that probably hurt us by focusing in the dividend camp is that while we had U.S. securities, given the nature of our income investors, we were cautious with currency. Now, in the equity strategies that we run, we stayed largely unhedged because we did have a view U.S. dollar was likely to strengthen versus Canadian dollar. But in the income portfolio, we weren't willing to make a 100% bet on a single security. And so much of the year wound up hedged on currency. And that likely cost us some money. That's the one decision I would like to have back. I think in the long term, the dividend growth part of large cap U.S. stocks is likely to continue to perform very, very well. Dividend growth was tough in the U.S. this year. It was tough in Canada. If we compare against those indices, we did very well. If we compare against pipelines, thank God we weren't there. If we look at high yield, thank God we weren't there. A tough camp this year for sure, and being down 5%, I'm not happy with that. But I don't think it's a disaster. If that's the worst that we throw at you at some point, I think that's not a game changer. The strategy will continue to work. These securities, I think, are likely to perform very well over the upcoming year. But this year was a challenging year for income. Having said that, we've spent the last 2 years pushing people towards equities. And in the equity camp, I'm very pleased with how things go. When you look at the pools and the funds, they've all performed well. Our global macro pool, which invests across asset classes, has had 3 mid-teens results over the last 3 years, up 16, up 19, this year up 13. The equity fund is up 9.5%. The balanced fund up about 5%, 4.5%. Balanced fund has had about a third of the volatility of the index, so it's had good returns with low volatility. All of our funds came through summer with significantly less volatility than the market. So if you look at a combination of returns, a combination of what the actual number is plus the volatility that you lived with to get it, I'm pleased with the risk-reward metrics in the portfolios, and I'm pleased with the way the portfolios have been positioned. Now, certainly there have been challenges through the course of the year leading up to the first Fed rate hike. Certainly there have been concerns about China. Certainly there have been concerns about emerging market debt and high-yield debt. And I don't think that those are necessarily going to go away. But in the background, what we do have is a slowly improving domestic economy in the U.S., driven by very low-priced energy, which is getting cheaper by the day. So where do we go from here? In general, we see very constructive market behavior coming from our key leadership groups. In the last 2 days in the rally off the lows, consumer stocks led, financials led, technology led, trading back towards their highs. And I think it's very likely now that we've got the first rate hike out of the way that we can continue to see good, strong price behavior from these groups. We saw very good earnings guidance coming out of the technology camp. Consumer stocks in the right areas are behaving really well. And the financials in the last couple of days leading into the hike really had very stronger than market returns. So look, I think that there are challenges. The things that we watch for is risk coming out of emerging markets. We have no emerging markets exposure. We look for risk in credit, in energy companies, and in basic materials companies. We continue to have no energy exposure, no basic materials exposure. We have no high yield exposure to speak of, outside of a couple of small positions in the balanced portfolio. The companies that we have exceedingly strong balance sheets. Our biggest weight across the firm is technology, where there's virtually no debt. And so interest rate increases unlikely to impact them. We have very little by way of industrials exposure outside of GE, which gave guidance to 2 to 4% revenue growth versus an industry growing at less than 1. So when I look at the portfolios today, our focus is the U.S. market. That's our biggest weight. We do have small weights in Japan and Europe across portfolios. We have sector weights that are the leading sectors in the market. The portfolios largely are unhedged on currency outside of the high-income portfolio. The 62-year-old baby boomer who will slowly work their way out of the fixed income camp are going to continue to work their way to dividend-paying equities. And we see no let-up in dividend growth in the companies that we have in the portfolios. So we've talked a lot about the fact that the strongest month of the year is December 15th to January 15th. I think that we've got a major hurdle out of the way, the first rate hike in 10 years. And we like the way the market behaved coming off of that. So the story hasn't changed. And we continue to think that we're in a long-term bull market for stocks. The portfolios were hedged early in this month. Coming into the rate hike, we've taken those hedges off. And I think are pretty fully exposed to market as it stands today. We're going to watch the risks in emerging markets. We're going to watch the risk in high yield. Those are important to monitor, but we don't have direct exposure in those areas. So at the beginning of the year, early in January, we're going to do a forward-looking outlook, and we'll talk specifically about where our positioning lies. But at this point, I don't think that there's anything significant that we have to change, and I think there's likely a performance chase into the end of the year in the leading stocks, and we're certainly, I think, there. So a little volatility in the month so far, but when you look at it, high income fund is actually up month to date 0.5%. The equity fund is up 0.23%. Global macro is up 0.4. The income pool is up 0.46. These are all against markets that are all down so far on the month. I'm happy with the low vol in the portfolios, and we look forward to 2016. So with that, I'll open it up to any questions.
If you would